Okay, and without further ado, Jordan Levine is the Senior Vice President and Chief Economist for the California Association of Realtors. Jordan is responsible for the housing market and economic research, as well as policy analysis for their legislative and governmental affairs efforts. He has a passion for homeownership, fair housing, and housing supply, and regularly represents realtors in the media. Jordan has a bachelor's degree in business economics from UC Santa Barbara and a master's degree with merit in international economics from the University of Sussex. Prior to joining the California Association of Realtors, Jordan worked in consulting for clients ranging from cities, counties, and states to private businesses and academic institutions. For all of you that may or may not know, we also, the official hazing day for the incoming president is the economic forecast that we have to give at the local level. Jordan came in clutch because he was here the day that he gave our last economic update. I didn't have to do it. So Jordan is a good friend of mine, and we would like to welcome him here today.
Good morning. Thank you for having me back. Yeah, I'm excited to be able to hopefully talk everybody down from the ledge. There's a lot of crazy stuff happening, but I actually remain still pretty optimistic. I think the sales numbers are going to stay pretty soft, but I think although the market is very challenging, I think there's a way that we can move the needle unilaterally, regardless of what the Fed does, what happens in the economy. There's a big education gap. You've got buyers and sellers that are hyper-focused on the short run and not the long-term benefits of home ownership. And so I think now is we're certainly in the midst of this shift, right? And the kind of challenges that consumers and clients need us more than ever. But that's also like what makes me really optimistic, because I'm trying to sell and buy right now, and it's really high stakes and challenging times. And so, the good news is also that they need us more than ever, right? When the market's just kind of stuff's flying off the shelves and rates are hyper low, we didn't have to work as hard. And I think we got to do a lot more on the buy side, both kind of encouraging folks and reminding folks about the long-term benefits of home ownership, which has fallen by the wayside when people are trying to time the market and buy low and sell high and wait for that perfect moment. And also kind of at the other end of the extreme, you have buyers who think like the market's terrible and I'm going to come in and name my price and they're going to give me a permanent rate buy down and pay my closing costs and all of this stuff. And I can name my own price. And the truth is really somewhere in the middle. Increasingly, I think we're going to have more difficult conversations with sellers, because over the last 12 weeks or so, the market has changed a lot. I made this, I think I showed you last time I was here, the purchasing power calculator shows what happens to how much you can afford if you wait for rates to go up, et cetera. Increasingly, I think that's a powerful tool to talk to sellers and use to have those conversations with sellers. Like I had my house on the market for like 47 days or something like that. Recently, we put it on at the beginning of August, and my agent's like, we need to lower it 40 grand to get this thing moved. And I'm like, it's bitter. And even for someone like me that stares at these numbers every single day and sees which way the winds are blowing, I'm like, 40 grand. Like I already had that money spent. My boat was already all picked out. And but I think again, it's important to have those managed expectations, both on the front end, like you should be using this stuff in your listing presentations, right? Just to show that the buyer pool has shrunk and there's not as many people that qualify for your home, everything else equal. And I think also probably will inform all the pre-listing stuff that we might have to do more so now than we had in the past, in terms of getting the house ready to go, spending some money up front, paying for staging, making it look really good, and all of that stuff that wasn't as big of an issue when rates were at 3% and anything that hit the MLS was going pending in 7 days. Things have changed. It's still a phenomenal time to sell, but I think on both sides of the spectrum, we need to be managing expectations. On top of that, I want to just throw out some kind of macro stuff, because the economy, I think, is going to be the biggest issue, both in terms of its effect on rates and what's going on with inflation and consumer spending and all of that stuff. But ultimately, I think it means that even if we don't get an official recession, and I think the bond market at least expects that we're going to maybe be able to achieve that soft landing that the Fed's been hoping for. But regardless, I think we should be prepared for an economy next year that's going to be slower than it has been up to this point. And I think that we should also be expecting that rates will remain elevated, even if they're not as high as they are now, at least through the first half of the year. We're going to still be in those kind of 7.5% range. And so that's important for buyers to understand, right? That you're not going to be saving a bunch of money. Prices are still going up. Rates are going to stay high, but it's also important, again, for those sellers to understand too. I want to put some of these big risk factors that I'm worried about on your radar, not because I think we're poised for a big recession. And you'll see when I get to the very end of the speech, we still have actually the economy growing next year for the year as a whole, but by a much smaller margin than what we've seen up to this point. We just got third quarter GDP. The economy expanded by 5%. Consumers are still out there buying stuff, right? Like cars, hotels, restaurants, all of that stuff is still kind of going strong, but I think there's a limit to how much we can expect consumers to drive the show. And that means that, you know, our clients, our buyers and sellers won't have that same economic wind at their back that they've had up to this point in the recovery. And that brings all kind of challenges again on what you should be in it for in terms of buying a house, and why it's still always a good time to own real estate. California, right? Like over the long term, prices only ever go one way, and that's like the first thing that gets dropped from the newspaper headline that says wait for the foreclosures and 5% rates are right around the corner, neither of which is true. And that means, again, always a good time to buy, still a great time to sell, but you just have to be a lot more strategic now and need a great agent that can help you position that house and like offer, you know, 3-2-1 buy downs and other stuff. Like we need to be bringing our kind of whole bag of tricks to bear, if you will, because buyers in particular, I think, are like super focused on what price they pay, right? And that's like their big number that they care about is like, I want it to be 500,000, I want it to be 450 or whatever. In some cases, you know, getting a rate buy down is better for you financially than getting like a $30,000 price reduction in a lot of cases. But again, this is where they, you know, really need us, and it's incumbent on us to not take it for granted and kind of keep your foot on the gas and embrace that role as the trusted advisor. Because again, I think that's the recipe for success, not just for surviving in a down market where the transaction volume is low, but for really setting yourself up for that long-term success too. Because if you help people navigate these kinds of times, they're going to the market is. There's actually a lot of opportunities out there. And I think even as markets like these that are still very, very inventory constrained, it's kind of a pain to work with buyers, right? You got to like spend hundreds and hundreds of dollars on gas, driving them around, showing them a million properties and filling out a million RPAs and getting them rejected before they finally get in. But if you look at the market, the size of the pie has shrunk, but the share of the pie going towards first-time home buyers is actually rising because they don't have a lot of this baggage that a repeat seller like me has, where you're grappling with like your life changes, but also, you know, your super low mortgage interest rate that you don't want to get rid of and stuff. And whereas a first-time buyer just wants to get their foot on the property ladder. So I think that it's great to work with buyers, and I'll show you my favorite chart in the entire world on what home ownership is all about and why you should be buying a house even when rates are at 8%. But I think it also kind of underscores that it probably behooves us as a business strategy to more drill down on some of these segments of the market that are still growing and not just take the shotgun approach, because there are other counter-cyclical stuff, which again, even though the overall pie has shrunk, all cash buyers are still out there. They like high rates because it gets all the pesky home buyers out of the way. You have people that are doing well at the top end of the economic spectrum that are still punching above their weight, spending money on vacation homes, second homes, you know, worried about inflation, worried about the stock market, parking their money in real estate, and all of that stuff is still happening. The other thing I just want to kind of throw out by way of getting up on the soapbox for 2 seconds is like, get involved and participate, like, you know, donate to RAF or respond to the red alerts and all of that stuff. Because in addition to having these kind of macroeconomic challenges that we're grappling with, higher rates, economic uncertainty, all of that kind of stuff, we also, especially here in California, have like a lot of self-inflicted wounds layered in on top of that. And although that's, you know, been kind of the bane of my existence career-wise, professionally, it is like an area where we can actually move the needle regardless of the macroeconomic environment. If we build more housing, it'll sell and it'll give people more options on where to move, and you'll get that existing stock moving over. The ADU laws have actually been having a pretty big impact in terms of getting new units online. We also have federal policy that's on the horizon, or at least being circulated around, in terms of the capital gains stuff that I think could have a big impact, even in markets like this. Very long constraining inventory, and that is an opportunity to raise those limits to get more units onto the market. And then, of course, I'll leave you with just the hard numbers, which is the forecast, and at the risk of kind of spoiling the rest of the thing, but if you got to leave early, the kind of punchline is that the market will improve next year, but it's not going to be a bounce back recovery, right? It's going to be a very slow recovery, not because we don't have enough buyers, even at 7-8%. I think the challenge isn't going to be where do we find the buyers, it's where do we find the units to put the buyers that still qualify into. And although I think that's going to be the thing that kind of proves your brother-in-law wrong, right? That prices aren't about to tank, that we're not about to see a bunch of foreclosures. That's also going to be the thing that really constrains the amount of transactions, because we just can't sell what's not for sale. And a lot of the kind of impediments to supply coming online, I think, are going to persist beyond just this current business cycle. And so I think, you know, the moral of the story again is that we don't have to panic. The economy is not going to completely fall apart. The bottom's not going to fall out of the marketplace, but we do need to very much, I think, embrace that role as the trusted advisor, bring the A game. Don't just be like a conduit for your clients through to the zip form, right? They need like actual advice and expertise and consultation and creativity. And I think that is how we kind of navigate this what will still be a challenging time, at least I think through the first quarter. So let's talk a little bit about macro stuff. Want to make sure that we're justifying the student loans, obviously, and also, you know, kind of set the stage for where rates are going to be and what that all means for the marketplace. The big thing that we've seen is that the economy continues to punch above its weight, whether it's these numbers, which are jobs, consumer spending. Again, the GDP number that came out last week showed us increasing at a 5% clip. That's way above the historic average. And actually, we're in this really bizarre, paradoxical time where good news is bad news. Like every time we get like a 336,000 job increase, or the economy expands at 5%, both of which are like objectively good things. We want the economy growing, we want people employed, incomes and all of that stuff. The stock market freaks out every time we get a good number like this, not because they don't want people employed, but because they think it means that the Fed is going to keep their foot on the gas in terms of interest rates. And so again, this kind of what would otherwise be really good news, that job growth and the economy continues to do well, is kind of another excuse for the Fed to keep rates higher for longer, which is what they signaled that they were going to do. And one of the big reasons for that, the kind of psychology behind that in the marketplace, is because of inflation. That's what the Fed is kind of laser focused on stamping into the dirt, right? As we got to get inflation back down to 2%. And a lot of this kind of last mile on inflation at this point is really labor market driven. At the beginning, when we were, and actually I think I brought this stuff, but you can see if you go back like a year and a half ago or so, inflation was running about 10%. That means the cost of everything that we're buying, haircuts, cars, bacon at the grocery store, all that kind of stuff was rising by basically double digits. We've made really consistent and significant progress. So most recently, the inflation number was about 4%. That's still kind of double where the Fed wants it to be. They want 2% inflation. So although it's moving in the right direction, the reason why the financial markets are still pessimistic is that a lot of that supply chain stuff that was driving the double-digit increases in car prices and TVs and all that stuff a few years ago has gone away, right? We turned the factories back on, we let people out of their house, and we started producing stuff and getting cars on car lots and all of that. The first piece of inflation is like the easiest to get rid of, because it was just flipping the switch on the economy back on. What hasn't been impacted by higher rates is this labor market shortage, right? So we're in this once in a lifetime period where the amount of jobs and open positions that we have to fill dwarfs the amount of people that are out there actually looking for work. And we had this kind of significant impact at both ends of the labor market. At the very kind of low end of the spectrum, service sector, you know, hostesses, waiters, hotel staff, things like that were decimated by the shutdown, because these were all the face-to-face stuff that we weren't letting people do at the beginning. But also since then, you know, things like childcare costs, cost of gas and commuting, and all of these things have in some ways really negated the benefits of work. Like in LA, I think it's like $2,000 per kid per month for daycare. So if you're making $15 an hour, you're really having to kind of crunch some hard numbers to see if that even makes sense. And indeed, the kind of service sector still hasn't fully bounced back from that shutdown, and it's still really hard to find cooks. You still see signs in restaurants like, yeah, we're closed for lunch because we don't have any cooks or dishwashers and that kind of stuff. At the other end, you got a lot of folks that were on the bubble of retirement, maybe like 50, 55 years old. Home values shot through the roof. We couldn't go in to the office, and work was, you know, a bit of a nightmare. And you had a lot of folks just retire early, cash in their chips, sell those homes, move close to grandkids, move into that retirement community or whatever they had been eyeballing. And the kind of medicine for fighting inflation, or the ammo that the Fed has in terms of raising rates, isn't particularly effective at addressing labor market shortages, right? Like if you were 55 years old and you bought a house in the late 70s for like 60 grand or something, and sold it for 750 grand and paid cash for your house near your grandkids, like, you don't care how high interest rates go, you're not like going to dive back into the labor force, and those jobs aren't easily replaced. Is why I kind of put like my inflation, I think, is going to be the hardest to get rid of. You know, it's not just a function of flipping the factories back on and chipping away at it. It's kind of like, you know, weight loss, or when you start going to the gym, if you're like super overweight, you know, you can go to the gym for like a couple of weeks, and like the months with no progress and like stepping on the scale and being depressed every day. That's how I think inflation's going to be, just because it's going to take a while to get those labor market shortages corrected. And we were at one point last year about 6.1 million workers short. That's since shrunk to about 3.2 million. But we still got a long way to go. That's a lot of people that need to come back and start being, you know, getting kicked out of mom's basement or whatever it is, before we kind of rectify that, which is why, even though we're moving in the right direction and probably will continue to do so, you know, I think your brother-in-law is lying to you when he tells you that those 5% interest rates are right around the corner, because the Fed is militantly focused on tackling inflation. Even just over the previous 3 months, if you go back to the end of the June meeting, they were a lot more optimistic than they were coming out of the September meeting. This was their quote unquote dot plot. So each one of these dots is like where a Fed voting member wanted rates to be next year, the year after, and the year after that. And you can see they were kind of expecting about 100 basis point reduction in the Fed funds rate next year, followed by 100, 150 the year after that. Well, fast forward to the September meeting, they were a lot less optimistic, right? Or a lot more pessimistic. So they expected to only bring rates down 50 basis points next year. And they expected the longer term rates to be a lot higher. And so even though I think you could easily, economy isn't as strong as what those headline numbers would suggest, and I didn't bring all my super nerdy employment data, but there is signs that the jobs market isn't as hot as what these monthly estimates would suggest. But the Fed thinks they're super hot, right? And inflation's still running strong. And if you kind of look at what's going on in the bond market, it suggests that 5% rates are not right around the corner. They actually didn't increase rates in September, but they did signal this like higher for longer philosophy of keeping those Fed fund rates higher. And you can see what that's done to the blue line, which is the 10-year, that over the last 8 to 12 weeks, I would argue that the bond market is finally like coming to grips with reality. It's actually really bizarre. If you look at this chart, the Fed funds rate, the black one, has like been going up pretty consistently. Like every single meeting, they're raising rates by 25, 50, even 75 basis points. And yet from the beginning of the year, pretty much right on through, actually even through the fall of last year, the 10-year was basically flat. It wasn't moving, and the bond market was banking that the Fed was going to bring down rates in a hurry. These portfolios were going to actually go up in value on the secondary market because the value of your funds the opposite way as the interest rate. If the rate goes up, then your bonds are actually cheaper to buy if they go down. And so anyway, they were really banking on this being very short-lived tightening cycle. And only once we got into the kind of September meeting and they vowed to really keep rates high, did you see that blue line finally start to catch up. It really hasn't made sense, honestly, that long-term bonds were about 250 basis points below the Fed funds rates. What we're seeing now actually makes the most logical sense out of anything we've seen. It's just been hitting us right in the pocketbook in terms of, purchasing power and home buyer affordability. If you kind of take that dot plot that the Fed broadcasts, and I take that with a huge grain of salt in the same way that they ratcheted up expectations by 50, 75 basis points over a 3-month time frame. They could easily back that down if the economy ends up not being as strong. So you don't want to take those numbers as set stone. But if you just do some simple back of the napkin calculations on what it means for interest rates going forward, and you take a Fed funds rate as broadcast and you build on normal like spreads of 2-year, 10-year, which is the yield curve essentially, and normal mortgage rate spreads, you can see we're in for a relatively elevated rate environment for the foreseeable future. In fact, we just revised up our forecast for rates next year to average 7%, meaning that we're going to start somewhere around where we are now, high 7s, 8%, start trending down maybe into the mid 6s by the end of the year. But that leaves us with an annual total of about 7.5%, and coming down very slowly thereafter. This isn't my forecast. This is just a thought experiment that says if the Fed does what they say they're going to do, and again, they can turn on a dime, but for those folks that think we're going to have a 3%, we're going to have a lot bigger fish to fry if shut down the way that we had during the pandemic, in which case we got, again, a lot of other issues with income and jobs and all of that stuff. So point being is that you're not going to be saving a bunch of money by waiting until next year to buy a house. And guess what? If rates do drop down to 5%, all that's going to do is bring all the other buyers back into the market, and it's going to cancel out the low rates with higher prices because everyone's waiting for the low rates. They're going to flood back in, and there's both supply and demand components to that. But the reality is that this has already had a huge effect on mortgage rates. I checked Mortgage News Daily this morning, and it's down to 7.85 or something like that. But we've been above 8% for a handful of days in the last 2 weeks. And even the Freddie Mac number, which is generally lower than what these daily rates we see quoted, are basically triple where they were when they were at those all-time low levels a few years ago of 2.65%. And this has had a huge impact on home buyer demand. The buyer pool, even just over the last couple of months, has really shrunk pretty dramatically. And you can kind of see that if you just do, again, a very simple thought experiment on what do buyers qualify for now that rates have made such a big change. So this is the kind of purchasing power calculator that I think I showed you last time. Originally, I built this as a conversation piece to have with buyers who were suffering from that like brother-in-law effect and thought prices were going to be half as much as this year as they were last year. Well, they've already missed the boat on that because prices have been rising almost every single month this year. But now they have that double whammy of super high interest rates. But if you just look at like a household in Kern County, relatively high income household making $120,000 a year, they have some money in the bank, they want to put 20% down, and they want that monthly mortgage payment to be about 35% of their gross pay. Well, if you go back in the time machine to when rates were at 3%, that household was looking at about a $775,000 purchase price at a 3% rate. So all of those people that were really, loath to click unsubscribe from their brother-in-law's email newsletter campaign against the housing market have really, are suffering from a major self-inflicted wound. Because if you just fast forward now that rates are at 7%, or now that they were at 7% a few months ago, they dropped from a $775,000 purchase price to a $540,000 purchase price. So not as many people qualify for the home that, that you're trying to sell as a seller out there. The buyer pool for your specific home has shrunk just by virtue of math, right? We don't have to, that's not an opinion. That's just straight up mathematics, to the tune of about $230,000, which is huge, right? Being able to find a house that's $230,000 cheaper is almost impossible, right? The inventory at the bottom end of the market is the most inventory constrained. And, I think that that's really a very challenging proposition. And those folks who were even waiting a couple of months ago have now suffered even further. As rates rose to 8%, they lost another $50,000, right? So now they're looking at a $500,000 purchase price. And so even there's fewer buyers, right? Not everybody can just absorb this increase in rates or put more money down or find a cheaper house. Those that do still qualify, I would argue, are a lot pickier, right? And I can kind of testify to this firsthand, right? That you've got a lot of buyers who maybe are still gainfully employed and can still qualify for a loan, but they have, $775,000 taste on a $500,000 budget now. And this is why I say we might be counseling folks to do a little bit more on the front end in terms of pre-listing activities, because they might still be willing to come into the market at an 8% rate, but they're not going to come in and then have a $3,500 payment on only a $500,000 home and then still have to dump another $100,000 into the house. That's not very palatable, because just a year ago, they were looking at much more expensive homes and their expectation kind of reflects that. And so even as I think this is an awesome tool to show buyers, like, hey, if prices do go up 5-6%, like Jordan said, next year, right, then you're looking at a 6% more expensive house still at relatively high rates. What you're missing is that you're not going to be paying down principal and accumulating equity over the short run, right? Like, the reality is we're all going to be paying somebody's mortgage over the next 12 months. The question is whether it's ours or our landlords, right? And you forget about that. Plus the market's still forecast to go up, but also as a way to kind of bring sellers back down to reality who have a house that maybe is sitting a little bit longer and not getting the interest, right? Because again, nobody wants to give up their boat that they've already got added to their cart online and stuff with the money that they already had spent. But through the lens of like me, right? I didn't want to lower it $40,000 and it was really, really painful. And I'm very up to speed on these numbers. That's actually a drop in the bucket through the lens of what's happened to purchasing power, right? Like when I've gone from being able to afford $775 to $500, the fact that the sellers made a $25,000 concession is great. I still can't afford it in many cases, right? And so I think, again, it's playing that expectations game and having the right data at your fingertips, because the data, I think, is a lot easier to accept than somebody's opinion, right? And a brother-in-law's email newsletter campaign. And this is why I say, even as purchasing power has been really rocked by these higher rates, and you can see the mortgage purchase applications in October were essentially at the lowest levels we've seen since the end of the financial crisis. And part of this certainly is that not as many people qualify, but I think we can move the needle on these numbers by showing people that it doesn't pay to wait, right? And that there's a cost to waiting, and that you're not going to accumulate that equity and be paying down principal and stuff like that over the near term, that the market's not about to tank. And so even though these numbers are very low, I think they're lower than they should be, even at an 8% rate. And that's where we, again, can have an impact. And, I kind of always, somebody asked me, how do we convince people to still buy and stuff? And I don't think we're in the game of convincing anybody of anything, but I think it's about putting the right information so that they're not suffering from self-inflicted wounds by putting so much stock in not fact-based information. And again, and you look at the fundamentals in California, and I think I brought some of this later on, but we just have too many people and not enough homes in this state. And this is a 35-year issue that's not going away by ups and downs in the economy. So even as prices are still very high, like California's median price is still in the kind of $850,000 range right now. But I think we're going to look back in 15 years or whatever and go, man, remember the good old days of $900,000 prices? And that is a function of just that fundamental Econ 101 supply and demand imbalance. Like my dad bought his house in San Diego. He built his house in San Diego in the late 70s. I think it ended up costing him like 65 or 70 grand. And he's like, this is insane. Like, why am I doing this? I have a $350 mortgage. This makes no sense. Like, what am I doing? This is suicide. That's a $1.3 million house in East County, San Diego right now. And that is just that, fundamental supply and demand issue. It's not the house that you envisioned as a kid when you thought, oh, I'm going to live in $1 million house or whatever. But that's just, again, because we've commoditized the housing market, and why I think we can have an impact on these numbers. Again, this is a big challenge with purchasing power, but I think it's also an opportunity to get folks refocused on the long term and not treating your house like you treat your Bitcoin, right? You can't live in your Bitcoin. And this also appreciates as well. But you can see the impact. We had a bit of a rebound during the first half of this year. Even with rates at 6.5%, the market was actually going up. But as they've really started to ratchet up over the last couple of months, you can see we've started to really threaten those winter lows from last year. We're still above the kind of low point that we hit of 230,000 units in November, but we're trending back towards those numbers. And I don't think we're going to see the bottom fall out. I think 230 is probably that low point, but we're not seeing that bounce back recovery. Again, part of it is demand, but another big part is just the lack of units to put qualified buyers into. And again, I think this is both a challenge and an opportunity to get folks onto the market sooner than later, because the prices will go up over the long term. If you look across the state regionally, you don't really see much variation, which is just a symptom of how much this is a macro driven show. At this point, it's mainly about rates and inventory and purchasing power all across the state. We're seeing the same kind of trends, whether you're in the Bay Area with like $2 million median prices, or in Shasta with like $199,000 median prices. We're seeing that same kind of 25-30% decline from where we were last year, on top of a double-digit decline. The biggest place that you notice it is segment by segment. And if you go back to 2021, when the market was really hot and booming, the state as a whole grew by 20%. But that was really just because the top end of the market was like doubling, right? If you look at stuff under 500,000, even during the boom years, we weren't selling a lot of $500,000 and below homes. There just wasn't a lot of those out there. Under 300,000 was dropping by 40%, even when rates were at 3%, right? So again, this is just the hardest segment of the market. And this is where the biggest change was, right? If you look at the last couple of years, under 500,000 doesn't look that much different than it has looked the preceding couple of years. The big change is that the top end of the market is no longer doubling. The top end of the market's actually still punching above its weight, though, right? When you just simple math says that if you grow by 110% and then drop by 30, you're still, 70, 80% ahead of the game. And indeed, if you look at the number of transactions happening above $1 million, it's still way above those pre-pandemic levels. It's just not exploding through the roof the way that it was when rates were at 3%. So again, top end of the market is still an opportunity. Those high income earners are still doing better than everyone else economically. And I brought local data, both for the month of September and for the year as a whole, but in some ways I didn't even have to, right? Because we're looking almost identical to those statewide numbers. We're punching above our weight just a little bit, right? But we're still down 20% in September, about 27% for the year as a whole in terms of transactions. Prices are still up though, right? So again, your brother-in-law really led you astray when he said that you were going to save a boatload of money by waiting till this year, because we still have a $380,000 roughly median price for the year as a whole. Last month, it was $385,000, up 5.5% from where we were even back in 2022. And of course, you can see how much listings are playing a role, right? The sales to list price ratio is still 100%. Most stuff is still going at or above list price. You still have a small fraction reducing. But again, this just highlights how much, even, as we're a unique market and picking off housing refugees from LA and things like that, and have kind of that relative affordability and more supply going for us, median time on market's still very fast and still have a very big deficit in terms of active listings for sale. And that will be the big limiting factor. That being said, I think the macro economy is our biggest challenge. And I talked a little bit about how the economy continues to overperform. The vast majority of the increase in GDP last quarter was still from consumer spending. So consumers are 70% of the economy. They're the biggest slice of the economic pie. They're pretty much the only slice of the pie that's been growing over the last 2 years. And that was true last quarter as well. And that's what makes me most pessimistic about the economy for next year, is if you look at how we've been financing all of these cars and TVs and trips to Hawaii and all of that stuff. Initially, we were spending up all that free money that we got deposited in our bank accounts for free by Uncle Sam, right? But if you look at what's happened over the last 2 years, we spent all that free money and then some. We bought probably one too many 80-inch TVs and all that stuff. And increasingly, as savings rates have hit 0% again, we see that we're relying more and more on the credit card, right? And so credit card debt's up about $150 billion from even those pre-pandemic numbers, and it's increasingly delinquent, right? The delinquency numbers are still pretty low. You're talking about 3%, but they were 1.5% just about a year and a half ago. So there's a limit to how much we can continue to rely on people buying stuff. And I don't expect a big consumer retrenchment where we're going to go out and start slashing spending across the board. But I do think eventually the credit card gets maxed out and you're like, oh man, maybe I can't get that extra TV, or maybe I get a smaller TV or whatever it is. And that means that we don't have a lot to fall back on economically. Most of our eggs are in that one basket of consumer spending. And with debt rising and the cost of that debt continuing to go up, I think we should expect that consumers won't be spending quite as much as they have been up to this point. So again, jobs won't be as plentiful, incomes probably won't be rising as much, and that is what matters for us as real estate professionals. The other big risk that I'm worried about is commercial real estate, particularly office, and to a lesser extent retail. I'm not that worried about industrial, and I know you guys have a ton of logistics facilities that are still going up and stuff like that. Those vacancy rates and rents are still doing really well. We still like buying stuff on our couch in sweatpants, right? So Amazon's not going away anytime soon, but the office sector is already facing real strain, and you can see that in California, we're at the leading edge of that. Our two major employment centers in LA and San Francisco are all already in the mid 20% range for vacancy rates. And we have really, I think, three major challenges facing the office sector. A is that remote work is still a thing, right? As much as employers want to get people back to the office, when you have this really tight supply of labor, when you have this labor shortage and a lot of open positions that you can't find good people for, you're not in a strong position in forcing people to commute to the office every single day. And although we're down from about 60% remote work, like 3 days a week was the norm, to just 25% or so, it's really plateaued at about 25 to 30%. And so at the end of the day, we're looking at about 2 days a week remote. That's a, kind of agglomeration of people full-time in the office, some people still full-time remote, handful of people doing hybrid and all that stuff, but it equates to essentially 2 days a week remote kind of persistently until things change. And that means you just don't have, as an employer, the same appetite for office space that you had when it was one person per office every single day. On top of that, the economy probably will slow. So even if you are successful at forcing everybody back to the office, you don't have as much money coming in the front door to be able to sustain your office space anyway. And then I think the third leg is the one that's the shoe that hasn't fully dropped yet, is that there's no such thing as like a 30-year fixed rate office loan, right? And so a lot of this office space will have to go out and re-up the debt at much, much higher rates. So even if you pass the first two tests, right, of getting everybody back to the office and still performing economically, it's going to cost you a boatload more to keep that space going at these commercial debt rates. And you can already see that the appetite for space has come down with these big vacancy rates. That's affecting rents and has also filtered through to CMBS delinquencies, right? So the people who own this debt are not being remitted back the money. Again, challenge is opportunity. I think you're going to see a lot of the banks that hold this debt being willing to make some deals on office space, because it doesn't serve anybody's interest to let a lot of this paper go belly up. But I think that this has the potential to be bad for a couple of years at least. And also, more importantly for us, because I know most of our kind of, folks are residential, but it has the potential to infect the rest of the economy, right? Because the banks are the ones that own all this paper. And if the debt starts going bad, we've already seen a couple of bank failures and things like that, and that can filter through the stock market, et cetera. And that's where it would show up for us in housing. So those are the two kind of biggest. Of course, we've got insurance issues, and I'm sure you guys are feeling that here in this market. My market is an absolute nightmare, but it's not just in rural areas where I live. 17% of the members that we surveyed this year said that they had difficulties with insurance at some phase of the transaction. Either it wasn't available, it was too expensive. Fair Plan was the only game in town. We had to there's not enough carriers. I don't know if I probably didn't tell you this last time I was here, but when I bought my house in 2017 in Atascadero, the annual premium was like $800 a year. 3 years ago, it went to $3,000 a year. Last year it went to 10,000, and this year I got dropped. So even at 10,000, they were unwilling to renew the policy. And we're not even in a high risk area. I think we're classified as high brush or something like that, but we've never had a fire. We're not high risk on the maps, but I think this is something that's still very much yet to play itself out. And the more and more I kind of noodle on this intellectually, or however you want to say it, is I think there's only one way out of this, and it means more expensive insurance, right? The insurance, even all of the solutions I hear kicked around, and most of them involve letting insurers pass on costs, right? Or insurers have their own insurance, right? So we could keep carriers here by letting them pass on the reinsurance costs. Like if you're State Farm and you write a bunch of homeowners policies here in California, it's not like a portfolio loan, right? You go out and take out insurance from like Lloyd's of London or some other carrier that's going to back you up so that if you end up having to pay out in the event of a major wildfire or something like that, then Lloyd steps up and reimburses you. Lloyd's isn't bound by California law, right? So Lloyd's in terms of the premiums that they charge to consumers, we could allow them to pass those costs on, and that would keep State Farm or Farmers or Allstate in the game here. But it doesn't mean that consumers are going to pay low rates. It just means that they're allowed to charge what Fair Plan charges, right? If you want to know what the insurance landscape looks like, get a fair quote. That's the market rate of insurance based on the perceived risk. And I think this is where this is all heading, right? Whether we get the carriers to stay here, it all basically revolves around looking at insurance premiums that look a lot more like fair than they do today. And that will have to be probably internalized by homeowners in these areas, because you're just not going to be able to charge as much. This is a huge challenge that still has like a TBD on it to be figured out. But I also think this is why it's very critical, and why I'm still optimistic for like my own job security. This is why we really need good realtors, right? Because we have a legal hotline at C.A.R. where you can call and get like free legal advice on all your transactions. And we've heard horror stories. We do like 80,000 calls a year. And a big chunk lately has been like people releasing investigation contingencies too early, right? And then these people that could still manage to barely qualify at 8%, barely manage to save up their 20% down payment, wait till the 11th hour to get their insurance quote, and now they've just lost their EMD because they can no longer make the deal pencil, right? And so this is, again, the deals are very high stakes right now, and why I'm still optimistic. You just have to be one of the very good expert realtors that's helping folks navigate all this stuff, and not a kind of cruise control, 1 foot in, 1 foot out kind of a member that's just letting people access your zip form account, right? They really need honest to goodness help. So every single one of these challenges is also a huge opportunity for the good agent that knows their stuff. And I think that's where you, again, build a business that's going to last forever, which brings me to kind of what we need to tell buyers and sellers out there is that inventory isn't picking up anytime soon. I think if you're waiting for that flood of REO inventory and a huge decline in prices, you're kidding yourself. and your brother-in-law is just not as good at math as you're giving him credit for. If you look at the loan portfolio of existing mortgages in California, and that's what I'm showing you here, it's like a pie chart of California mortgages over time. 93% of the homeowners here in California that have a mortgage at under 6%, right? That means they're facing a huge financial penalty for leaving that house, right? And I don't agree with this, but Lawrence Yun, the NAR chief economist, said it his most recent forecast. He's actually like projecting divorce rates are going to start declining in the coming years, because even if you hate your spouse, you love your mortgage, and you're going to try and keep that going. As somebody who's getting divorced, I vehemently disagree. It's the best money you could ever spend. But I do think it kind of underscores why we should expect inventory to stay very low, right? Is that if you've got one of these lowest rates of all time, you're, even if you've got a gun to your head like me, you don't want to walk away from that house, because I could sell my house for $1 million, but then I'm going to go buy something that's 600 that is a lot not as nice, shall we say, generously, and my payment's going to be more, right? And so it makes sense for me to take out a 10% HELOC and to buy my ex out and do all that stuff. You even see all kinds of creative stuff. I did a home ownership fair about 2 months ago in the Inland Empire, and I was up there like preaching for, and evangelizing for home ownership. And then they had a bunch of lenders come out and talk about 3-2-1s and how you could still make deals happen. And one of the lenders actually had a client who they were getting divorced, and instead of selling the house, they were taking money out and building an ADU in the backyard, and the wife was going to move into the ADU, and the husband, I took her card, but I was like, man, I don't know if I got the stomach for that. But again, I think it just kind of underscores why inventory will stay low. That being said, though, if you look at this chart, there is still a ray of optimism, even under the kind of surface of these numbers. 2/3 of homeowners have a rate that's even below 4%, right? And those people probably are going to be really loath to move, but that still leaves about 1/3 of the market. It's somewhere between 4+, right? And so for those folks, it doesn't take huge movements in rates, right? You get somebody at 5%, once rates get down to 7, 6.5, then you're not asking them to eat that much relative to where they are now. And so even as rates come down very gradually, I think we'll see inventory increase just a little bit. And you're going to have people with all that credit card debt that need to tap home equity. And it might make sense to just sell that home and do all that stuff. And eventually we'll see inventory not get back to normal, but it won't be so hyper depressed the way that it is now. And I have every confidence that when listings hit the market, they still sell even at the relatively depressed levels of transactions. But we got a lot of people staying in their homes, right? And there's no doubt about it. This year's annual housing market survey that we did, we set an all-time high for how long a seller lived in their house before selling it. And these are people that actually moved. It used to be like 5-6 years, right? Last year was 12 years, and those are people that actually turned over. So that doesn't count all the people that bought in the late 70s that are still living in those homes today. And again, not just that lock-in rate from low mortgages, a lot of people facing capital gains, a lot of people just discouraged by the lack of inventory, right? Even if I am willing to walk away, or I don't have a mortgage at all, I'm not facing capital gains. Yeah, I can sell my house, but where am I going to go? There's nothing good to buy. And so you see a lot of people just putting money into their house. It's hard to find a contractor to come and do little stuff because people are just investing in staying put. And you see that continuing to impact stuff. But as much as I think supply is the limiting factor, I'm like increasingly, and maybe this is just a bias because I'm trying to sell my own home and it hasn't sold and I've had to reduce price and all of that stuff. It's, I think, really important that we make sure sellers know which way the winds are blowing, because the market has changed dramatically and supply is the limiting factor. It's still an amazing time to sell your house, but it's not as red hot, white hot as it was a year and a half ago when your buddy or your brother-in-law or whoever sold their house and it hit the market and sold in 6 days. And you can see that the mortgage applications are way below where they were even last year. Forget about where they were in the preceding couple of years before the pandemic, and certainly way below those 15-year highs that we hit at the end of 2020, beginning of 2021. And that means that you have to be strategic. You have to be willing to make the house look good and spend a little bit of money to get it sold and be priced right. We have to negotiate again. We have to potentially offer concessions and things like that, because it's really easy for somebody who, isn't in the weeds of this stuff every day to look back at their neighbor's experience from 6 or 8 or 12 months ago, or what happened when their brother sold the house and whatnot, and not realize that the market has shifted pretty dramatically over the last 8 weeks. You can see the median time on market last week was 19 days. In Bakersfield in September, I think it was like 10 days. So the market's still hot, right? But it was like 5 days, right? And so it is taking longer for these homes to sell. And that is important for you to know. It's also important as a seller to understand that, yes, it's a great time to sell. Not that many people are reducing. You're talking about 1 out of 3 listings last week were below that original list price. But if you look at the trend line, it looks the same as the days on market. It's been trending up. More sellers are hurrying up to cut or do a buy down or whatever else. And so as much as I want to hang on to that boat and I'm not going to remove it from my cart or whatever, other sellers are doing that, right? And so it's important for you to understand the purchasing power implications of these higher rates, and that there just simply mathematically isn't as many buyers, and that other sellers are willing to compete for that smaller pool of buyers. And so you can still get a great price, but those people have $775,000 taste on a $500,000 budget. So we got to price it right. We got to make sure that it's ready to go, because, smaller buyer pool, much more picky buyer pool, right? And so they really want it dialed in and ready to go. If you do that, it's still a phenomenal time to sell. We had more than 2 out of 5 closed last week, closed above list, right? So it's not 3 out of 4, but it's still 2 out of 5. It's still an amazing time to sell, but we do have to be more realistic than we have had to in a long time, right? But as a buyer, again, yes, the interest rates are high, but all the other things have actually started to trend towards the buyer's favor, right? Sellers that are willing to work with you, homes that are taking longer to sell, fewer buyers competing with you over this limited pool of listings. And that is actually a good thing. So, everybody's hyper focused on the one negative and forgetting that comes with a bunch of other positives. And I don't always buy this argument, but they always say, marry the house, date the rate. That's like pretty true as long as you're putting money down. If you're coming in with 0%, you can't date the rate because you're not going to be able to refi that quick. But to a certain extent, I love that, because you're still paying down principal. Even if the market doesn't move at all, at least some of these fixed rate loan payments are towards principal. And we do think prices will continue to go up. So you're going to be making money over the interim. And if we do get 5% rates, and lo and behold, your brother-in-law is smarter than me, you can capitalize on that while you're still making money in the interim, right? That you're not paying somebody else's mortgage for them and just flushing money down the toilet. These are all the things I think that buyers and sellers need to know. This is all stuff that I think the data really helps us to teach people and really fix that education gap. The market's not going to bounce back to 510,000 units the way that it was, but it doesn't need to be down at 240. And this is where I think the real estate professional is so critical. The other thing that we need to be telling buyers who are hyper-focused on their house tanking in value and being the last one into the market and left holding the bag and all that stuff is that, A, there's no major foreclosure crisis on the horizon, but B, home ownership's about the long run. This is my favorite academic journal article in the world. If you ever only read one economics paper in your life, read this one. It's from the Harvard Joint Center for Housing Studies. And I still always get people that come up and say, yeah, if you just rent and take that money and do other stuff, you're going to end up better off. You don't have to take my word for it. They did a empirical study in 2013 after the market had already tanked in the 2008 financial crisis, and said, yeah, you can come up with a study on paper that shows a renter ending up better off than they would have been by home ownership. In practice, we do not observe those outcomes, right? Even after all the money that people lost when the market went down and then came back up, people were still better off financially than they would have been. And actually the reality is that renters don't end up taking any differential that they might save on a mortgage payment compared to rent, which I think is debatable in the first place. Rents are no picnic right now, but even if you hypothetically could save money, by renting, you don't end up doing all this whiz bang financial stuff and getting in on the ground floor of Bitcoin. You end up just consuming more, right? You live in a fancier apartment, you drive a car that's, more expensive than what you should be driving. You finance rims and do all other kinds of crazy stuff that you see people doing. You're like, I got a 3-year rim loan for my car. And you see that kind of stuff happen out there. And the proof is in the pudding, because the Fed just released their 2022 survey of consumer finance. This is a survey that they do every 3 years. And this is my single favorite chart in the entire world, because if you look at the $190,000 or so that the typical household has in net worth in this country, and you break it down between owners and renters, you see that Harvard Joint Center for Housing Studies paper was 100% right. Renters are no better off today. They're $600 better off now, I think, or no, $1,000 better off now in terms of net worth than they were 30 years ago in the mid 1990s, right? Renters do not end up doing all this whiz bang financial stuff. They finance and refinance rims and watches and go to Hawaii and do all this other stuff. Homeowners are the only ones in this country with any wealth. That's what it's all about. I'm the son of a guy who didn't even graduate high school. I'm not here today doing super nerdy, esoteric economic speeches because he knew all these PhD economists. He bought his own home, and he actually died. I didn't even inherit any of the wealth from that home. But what it did let me do was just focus on going to school and being a math nerd and developing my spreadsheet skills and whatever. And that is what it's all about. And it's not about timing the market. You get your foot on the property ladder in a home that you like, that you can afford the payment on, and you reap these gains that are so well documented in the academic literature. The other thing is, again, your brother-in-law sucks at math. There is not going to be a big foreclosure crisis. Delinquency rates in California are 2.4%. That means 98% of the mortgages here are being paid on time. You don't throw the keys back to the bank when you have a fixed rate loan that you're current on your monthly mortgage payments on, right? The other thing that you don't do, that's like kind of strike one, right? Is like, I'm caught up on my payments. Why would I foreclose? Strike two is that I have a lot of equity in my home. We have a bigger percentage of homeowners with a bigger amount of home equity than pretty much any other point in time. And you don't walk away from a home that's worth more than what you owe on it. That is strike two. Strike three is obviously the prices are actually going up. So why would I throw away an asset that's appreciating in prices? Although they went down a little bit in September from August, that's a normal seasonal decline. On a year-to-year basis, we just had our third month in a row where prices were actually up 3%. And I showed you the Bakersfield data. We were actually up 5% in September on a year-to-year basis. So yes, we're having that same seasonal cool down. Spring home buying season has ended, but prices continue to appreciate because inventory is still very tight. As big of a hit as demand has taken, supply's taken an even bigger hit because of that lock-in effect, and that is why we still see this upward pressure on home prices. So strike three, your brother-in-law is out. Last thing I'll say is just that those market segments that are still growing, I already kind of alluded to this, but work with buyers again, right? They're a pain in the butt. It's really rewarding to create more people like my dad, whose kids and grandkids are going to come and replace me in a few years. But also, I think smart business strategy, because the pie has shrunk, but this is a slice of the pie that's still growing, right? And a lot of elbow grease, a lot of gas money, all of that stuff, but both rewarding and smart business. High income earners worth your attention and will continue to outperform economically, and they're still putting their money into real estate, whether you look at it as a share of people buying second or vacation homes, or people paying all cash, or people investing, including flippers, right? That's one of the byproducts of having buyers that are hyper picky, is that you get flippers coming in and saying, I could come in and spend 30, 40 grand and turn this around for money. That's going to generate some transactions as well. So I think focus on those kind of segments that are still poised to do well, even in a down market. Last thing is, again, evangelizing for RAF and, red alerts, and any way that we can use our voice as people that are on the ground, because things like capital gains, and if you do the calculation at current thresholds of 250, 500,000, I'm estimating about 2.7 million households are above that capital gains limit. That's just another reason why they don't want to move. There's a bill in Congress right now that's floating around from Jimmy Panetta, who's our congressman over in the Central Coast, called it's got a super clunky name. I think it's called like More Homes Available for Sale on the Market Act or something like that. but it would raise the capital gains threshold to 500,000 and $1 million, and then index it to inflation going forward. And if you do the analysis, same analysis of California households on that basis, it drops from 2.7 million households locked in to just over 1 million. That is a lot of potential inventory that could come on, and why, again, I think we can use our voice to make smart policy that will help regardless of what happens in the macro economy. And so I think that is kind of the recipe for success. Again, our economic forecast isn't that dire. We do have growth slowing down, and we have rates remaining relatively high next year in that kind of 7%, high 6% range, maybe by the end of the year. But we actually have the market bouncing back, right? We have sales going up about 20%. And I had a reporter call me and say, how are sales going to go up 20%? That's crazy. It's still to a relatively low number of about 320,000 units. So nowhere near that 510,000 units. But I do think this will be the low water mark of about 230, right? Part of the big percentage increase is just law of low numbers, right? If I have $1, you give me another $1, I just got 100% raise, but I've still only got $2, right? That's kind of where we'll be at with the transactions. But we actually have prices continuing to go up, right? So just yet another reason why there's a cost to waiting. Rates aren't going to come down super quick. And as sellers, we just really need to be aware of which way the winds are blowing. So again, I think the key is to embrace that role as the trusted advisor, lean on this data, and I'll make sure that you guys will actually, you already have a copy of these. I think Jamie has them, to have those, conversations and get people off the fence as a buyer and reaping those benefits for the long term, and getting the sellers to come down to earth and realize that it's an amazing time to be on the market. You just have to be a lot more strategic, and that is your biggest sales pitch, right? So I think those that do that will not only survive but thrive, and I so appreciate the opportunity.
So one question from Zoomland. Where can we find your affordability calculator?
Yes, if you just Google like C.A.R. purchasing power calculator, I think it comes up. I should know my own website better, but it's under if you go to CAR.org, it's at the top, Industry 360, and then there's interactive data, and it'll be right in there. But I think if you Google, it'll work too. Google C.A.R. purchasing power calculator. I think even maybe C.A.R. calculator might work too. Or email me. My email is jordanl@car.org, and you can always send me an email. We also have a ton of good like infographics and local data that you can download and share on Facebook and do all that kind of stuff too. Jeannie.
Every week.
Yep.
Sorry.
Yes. So Jeannie pointed out that the Bakersfield stuff, we're updating that, and we have actually like 5 or 6 different infographic-y, camera ready, kind of shareable local market reports. And I think we even have like Ridgecrest and I think we have a handful of cities in Kern County, and we're refreshing those every week, every month, and they're getting put up. We also have a podcast that you can listen to if you just missed my voice or whatever. And that is very informal, and we just kind of chat about the news of the day and whatever happened in the last week or two. We try and really facilitate and I think just kind of going back to what Derek said about all of the things happening on the legal front and everything like that, I think I'm not in the minutia of all the technical legalese and stuff like that. But to me, the solution to all of these various things, whether it's the class action, the DOJ, the buyer broker, and all of that, is just to be uber valuable to consumers, right? If you're really helping people buy and sell and avoid losing their EMD, and helping them to negotiate and getting them a good deal and getting them buy downs and using all these tools at our disposal, we don't have anything to worry about. People are going to be grateful that they had I would pay my agent more. I would pay her with a buyer broker. I would come out of pocket because even as somebody who's in the weeds on this stuff, you really, really need, Gov, you guys all probably know Gov, but he talks about how when he started in the business, like the RPA was like a page long, right? Now it's like 40 pages with all these boxes and all this. That's like, there's no way a regular person knows what they're getting into. And you even see these FSBO people come in and they're like, oh, I got a copy of a form and I'm just going to sell it myself. And they're like filling out this 10-year-old form that like they're going to get sued and they're going to get hammered for it and stuff. And so Yeah, I think the recipe for success for us as associations is to make sure that you have the information you need to really be those experts out there. And your kind of end of the deal is to be the expert and help these clients. We're in it arm in arm. And I think as long as we both deliver on that, then we'll all be in good shape and we almost don't have to worry about all this stuff. So. Yes, sir. The infographics are also on CAR.org under that market data section. There's 2 links, right? When you just click on that top line drop down, one says shareable reports and one is interactive data. Yeah, /CAR.org/market data. Everything is right there. Or again, just email me. I sometimes can't find stuff on there either. So.
I'm glad you brought up the insurance
Yeah.
because I just got a renewal on mine like 2 weeks ago
Mm.
and I about fainted.
Me too.
And went up from $1,200 a month to $3,400. And I looked at that and I thought, this has got to be a mistake. So I called Farmers, called
Yeah.
my insurance agent. It's not a mistake. They get out at Solera, where I'm at. It's now in a zone 1 of what they call their fire graph,
Yep.
and I'm like, you got to be kidding me. What if it was a 4? And so I think it brought to my attention now, because usually when we go into escrow, we don't talk that much with our clients about insurance. We don't.
Yeah.
They know they got to get it by the time, but we don't really.
It's a negligible cost usually,
Exactly.
right? Like, yeah.
So it's no big deal. But now I'm like, man, I got to tell these buyers from the very beginning, get your insurance now.
Yeah, do it.
Don't wait till the last week.
Yeah.
And then like you pointed out, then now you don't qualify.
Yeah.
So I guess my question is there anything we can do about this? I mean, when it's in an area that really is not a fire area, that all of a sudden we're being penalized? It goes up, is right on the form, went up 281%.
Yeah. I don't know what the solution is. We could try and spread it out across more homeowners, like, earthquake insurance is kind of, you never know where the earthquake insurance is or earthquake's going to hit. And so just like the cost of earthquake insurance is pretty high across the board. I think you could potentially see more of it get passed on in premium quotes in lower risk area, like urbanized areas like LA, and you might see them start to pick up some of the slack and stuff. But I think some of it's going to have to be internalized by existing homeowners, and people are going to really have to look at whether they want to live in some of these areas. I also think, like my area in Atascadero, we've never had a major fire, but they consider it high brush. And like even though the state maps don't consider it high risk, the insurers have their own maps and stuff like that. But I think, you go several years of having stuff, no major disasters, and we are coming off a bunch of mudslides and fires and stuff in the preceding handful of years that I think has scared insurers off. But I think there's still just a lot to be figured out. And I think ultimately it adds up to more expensive insurance. But I do think we've the pendulum has swung way to the extreme, and you had a lot of people back out and just availability is gone and super high premiums out of fear that may back down a little bit. But I don't think we're going to ever get back to I don't expect my house to ever have an $800 premium anymore. Yeah, it's brutal. Did you have a question, sir?
Yes. Whether you've done any projections on what appears to be a very chilling effect of this insurance problem on sales and lending. I mean, it appears to me it's going to turn off lending, and you're not going to be able to buy or sell houses in anywhere except in an urban rated fire zone, because the premiums are going to be unconscionable.
Yeah, a lot of the transactions that we have in the state are in our urban areas. And so it's like, actually, I'm always like the voice of reason at C.A.R. And when it comes to lobbying efforts, they're like, yeah, most places you could still get insurance and stuff like that. I'm like, yeah, come out to my neighborhood. But I do think it's depressed the level of transactions beyond just what it needs to be. And most people have to have insurance, right? Like, I think you will see a lot of the all cash, and people at the top end may just end up kind of rolling the dice. and not paying 30 grand for insurance. And right, if your house doesn't burn down for 5 years and you're paying 30 grand a year, then you might be better off just kind of gambling. But you can only do that if you pay cash. And so it will impact the market. But I think, Fair Plan is still out there. Like my quote from Fair was like $3,500. So it's not enough to push me completely out of the house. But I think it will be at the margins, sabotaging some deals. But I think it'll just be, a filtering process where the people that are right on the bubble drop out, and you'll just be relying on people with deeper pockets so it's just a smaller buyer pool, meaning that, again, realized by the homeowner, an existing person who wants to sell. I think they'll be able to get it. They're just going to have like no actual coverage, right? Because you're going to keep it going by having really low coverage and really high deductible. And so it's going to be insurance and name only kind of. It's probably the way. You don't really, where are you going to go, right? You're going to sell. You can't go rent anywhere. You can't buy somewhere else unless you completely leave the area. And so I think that's kind of what the short run fix will be, is let's jack up the deductible and lower down the coverages. Yes, ma'am.
So independents get their funds or get their money to fund the insurance from travelers. So if you run up against a bad situation like I did, I have a relationship with about 3 or 4 private insurance companies now here locally, and they'll fund your loan. But you've got to know it's the backing of Travelers Insurance. And I don't know about out here with the fire potential, but that would be one area that I would try a Travelers. Yeah. And independents use them. So when you call an independent, Clifford Bradford, Fall Getter, there's a bunch of them, and that's who they get their funding from.
Yeah, I think there's a lot of options. Of no holds barred, I think we could come up with creative solutions, right? Like I always like sticking it to the tourists, right? Like, could we charge something at the airports or some kind of like a hotel fee? It's like, you want to come enjoy our beautiful state and do all that, which we're still a top destination in millions. You know what I mean? We could charge everyone that lands at LAX $5 and use that to subsidize insurance costs and stuff, or, but what do I know? Oh, yeah.
Thank you. I just read a couple of days ago that the Biden administration is launching a multi-agency effort to encourage states and cities to convert more empty office buildings into housing units, with billions of federal dollars available to help spur the transition. So I think that might be encouraging.
Yes.
Yeah.
No, I say God bless to that. It's kind of a win-win, right? You alleviate some of the strain on the commercial stock that's not having a lot of interest in it. The only challenge that because we actually did a big study on this at the beginning of pandemic, and we have a lot of office space, and even a small fraction of that getting converted over to residential would result in a lot of units. You can easily come up with a couple 100,000 units with very, modest assumptions about how much gets converted over. The challenge is that it's not necessarily conducive in office buildings to residential because of the way they're built. There's normally like one main wet wall, and it's mostly a plumbing issue, but there's one main wet wall where the pipes go straight up and down. So if you ever been to an office, like the bathrooms are in the same location on every single floor, and that doesn't lend itself to having a bunch of units with toilets and bathtubs spread out across the entire structure. So, and if you look at the rents per square foot on office space, they're a lot higher than per square foot apartment rents. So there would have to be some kind of a tax credit, or vacancy rates would have to get so high that would cancel out the per square foot differential on rents. But I think the government could throw money at it. We throw money at a lot of other stuff that wouldn't be as beneficial. So why not?